In this video, we're going to be talking about Synopsys. Synopsys is one of those companies that most people never really hear about, but it sits behind some of the most advanced technology in the world. Companies like NVIDIA, Apple, or Broadcom can manufacture a new chip, but that chip first has to be designed, tested, verified, and prepared for manufacturing. And Synopsys sells the software that the engineers used throughout the process, okay? So this is not normal productivity software. Synopsys sits very deep inside the semiconductor development. In this video, I want you to understand what Synopsys actually does, why the moat is so strong, and then in the second half, we're going to take a look at the numbers and see whether the stock is actually attractive at the current price. Synopsys stock sells software that is used to design and test semiconductors. They sit in the electronic design automation industry, so EDA. A chip company can start with an idea or an architecture to build a chip, and then the engineers, they use Synopsys tools to design the logic and structure of that chip. So this is where the concept starts to become a real product. The design then has to be verified, optimized, and checked for timing, power, layout, and reliability. All of these, they need to work out. If any step goes wrong, the chip can fail, and then it requires an expensive respin. Synopsys helps prepare the design for manufacturing. So they work with the foundry process. In simple terms, Synopsys helps turn a chip design into something a foundry can actually build. So Synopsys provides the software layer and between the chip idea and the finished silicon. Without software like this, modern semiconductor development is impossible. So in this industry, we have an oligopoly in this EDA industry. So EDA, this is not a normal software market, okay? It's not like CRM where hundreds of companies compete for the same customers. And it's not a normal oligopoly either. I'm gonna explain it to you right now. So we have the big three: Synopsys, Cadence, and Siemens EDA. These three control the critical tools used to design the most advanced chips, okay? Everyone else is either selling niche tools, older technology, or serving in much smaller parts of the workflow. So the barriers to compete at this level, the barriers to entry in this space are extreme. You need decades of software development. I mean, you need decades of R&D, thousands of engineers, and billions of dollars. Even if you have all of the money, you cannot just, here's $100 billion, build me a competitor to Synopsys. It's just not going to work. You need experience. You need to go through the process of designing chips and improving it step by step. You cannot just build a competing tool and convince NVIDIA and Apple to bet their next chip design on it, okay? It's not going to work. So you need trust, accuracy, certification, and this takes many years to earn, okay? So customers, they can use multiple tools from this company. All of these three companies, they compete against each other, but they can coexist. When someone like Intel, okay, comes up with a new chip idea, they might start using some of the tools from Synopsys, then they move to Cadence, then they move to EDA, and then they move back to Synopsys for verification. It's not a normal oligopoly, okay? It's not like, oh, it's either this or that. No, they coexist from the beginning into all of these semiconductor design companies like AMD and Intel, and even within Taiwan Semiconductor, the foundries. So yeah, these customers, they use the multiple tools from these companies, but the designers, they mix and match. But these three are always in the flow. They're always present. And the pie, it keeps growing, but the pieces, they stay with the same players. So demand might get bigger and bigger over time, but it goes to these three basically. Okay, so this is non-optional software, of course. This is not just useful software or nice to have features. Okay. If you want to design a chip, you cannot skip this. So this is what I like to call a choke point. Okay. If you want to do something in the semiconductor industry, you have to pay Synopsys, you have to pay Siemens EDA, you have to pay Cadence. Okay. Non-optional. Synopsys will help you handle these critical steps. Without software like this, it's just impossible to even think about manufacturing. Okay, it's just not going to work. So the cost of the EDA software is very small, actually, with the cost of getting the chip wrong. So a failed design, like we talked about, it can mean delays, which means possible market share loss to your competitor, wasted engineering effort, missed product launches, and a costly respin. It's not like a respin doesn't cost money. I mean, it's going to cost a lot. That's why the software, it sits very high on the priority ladder. First of all, you cannot skip it. But yeah, this also means it has pricing power. Okay, so if Intel or AMD wants to budget somewhere, they're gonna cut marketing. They're gonna cut some office spending. Okay, which can be reduced. Maybe some nice to have tools that can be reduced. With software tied to directly to verification and sign off, it's just not gonna happen. You're gonna have to pay Synopsys. Okay, this is exactly the type of business that I like, because like I said in previous videos, I am extremely concentrated, so I like to own only a few stocks, and this is exactly the kind of stock that fits my investment strategy very well. Mission critical, upstream, hard to replace. It's not selling something optional. It's selling software that basically is mandatory for the semiconductor industry to exist. So if you think about ASML as being a monopoly in the EUV machines, it's the only company that sells those. Maybe in 10, 15 years, we're going to have a competitor to that. And it's going to be like Micron and SK Hynix and Samsung, okay, you know. But you just cannot. This is a much bigger choke point. Before the chip even gets to touch an ASML machine, it has to be designed. And Synopsys is even higher, even more upstream than ASML. So before ASML gets paid, Synopsys gets paid. Okay. And guess what? I mean, we're gonna go into the numbers very soon, but I think for the moat that it has and the growth that it has, this company is trading very cheap. But let's continue with explaining Synopsys as a company. Now, this is the failure path. Synopsys sits directly on the failure path of semiconductor design. So failure path or kaboom prevention, these are my own concepts that I use in my investment framework. So what I mean by this is simple. If the software does not do its job properly, the consequence is that it's not that some employee is going to lose 10 minutes of productivity, okay? You will end up with a chip that fails. That's extremely bad, okay? So before a chip goes into manufacturing, engineers have to verify design, check the timing, power consumption, the layout, the signal integrity, reliability, and then a huge number of other things. And Synopsys sits right inside that process. If something important gets missed, you can have delays, a failed tap out, or eventually a manufacturer, you will end up manufacturing silicon that needs to be redesigned. So that's where the economics become very strong for someone that sells this type of software, because the cost is tiny compared to the cost of getting the chip wrong, like we talked about before. So the value of Synopsys isn't that it just helps engineers design chips. A huge part of the value is that it helps them avoid catastrophic mistakes before those mistakes reach the physical world. This is what I call kaboom prevention. Okay. So I love businesses like this because the customer isn't just paying for convenience, they're paying to reduce the probability of an extremely expensive failure. And the larger and more complicated these chips become, then the more valuable that protection becomes. So from an investment philosophy perspective, Synopsys scores extremely high in my investable universe here. So it's mission critical, sitting this directly on the failure path, where the cost of failure can be enormous. So this is not, I'm kind of overlapping and repeating myself here, but you have to understand how very different the moat is from simply having a popular software product. This is not a popular software product, okay? In costs and institutional embedding. These are another two philosophical filters that I use in my investment framework. So let's say a semiconductor company, they start using Synopsys product. It doesn't just buy one feature and use it in isolation, okay? Over time, these tools become embedded into the entire engineering workflow. Engineers are trained on them, internal scripts are written around them, verification environments, libraries, design constraints, automation tools, and internal processes are all built around this software, okay? So switching is not simply a case of just canceling one subscription and buying another one. You have to retrain engineers, rewrite scripts, rebuild parts of the workflow, okay? Revalidate processes, and then you have to make sure all of the new tools still work properly with the rest of the design stack. All of that takes extreme amount of time and effort. So more important, and also more importantly, it introduces risk. So if you're designing a chip that may cost billions of dollars to develop and commercialize, you're not gonna just casually change critical engineering tools, okay? Just because another vendor offers slightly a cheaper license, okay? So think about Apple. They use some products from Qualcomm. They use some tiny little chips from Qualcomm. From beginning next year, they're gonna ditch and design their own chips, and they can do that because they already designed their own chips for the Macs and iPhones and everything. They already have a team of engineers that can design and develop chips. But you cannot just say, okay, we're Apple, we're gonna build our own Synopsys EDA software or something that can do the job. Impossible. They're just not. It's gonna cost them so much time, and it's gonna be a mess. So there is another layer, which is institutional embedding, another layer of the moat. Okay, Synopsys has been part of the semiconductor ecosystems for decades. Okay, large chip companies, they know the tools, engineers know the tools, universities and schools teach these tools, foundries work with these tools. Okay, entire teams are hired with already having experience using Synopsys, Cadence, and Siemens EDA. So the ecosystem itself starts to reinforce the incumbents. Okay, the more engineers know Synopsys, the easier it is for the companies to hire people who can use it. Then the more companies use it, the more workflows gets built around it, and this is a powerful cycle. So chip can use tools from multiple vendors, and they certainly do. And Synopsys doesn't have a complete lock on every customer that gets into this industry forever, but starting to replace deeply embedded critical tools is expensive, disruptive, and risky. So that's what it matters. The moat is not that switching is impossible. The moat is that switching has to be worth the engineering costs, the retraining costs, the validation costs, the execution risk. And when I look at Synopsys, I see obviously much more than a normal software switching costs. Okay, this is not like designers trying to migrate from Adobe tools. Okay, even that is a very strong argument for that type of moat, but this is on a completely another level. Okay. Okay, so here we're going to talk about another choke point in the moat. So the foundry itself is not Synopsys' choke point. The important thing that you need to remember from this part is that Synopsys is deeply embedded in the bridge between the chip designer and the foundry. Okay, so a company, a semiconductor design company like AMD cannot just design a chip and in any random software and then send it off to TSMC. This design has to follow the exact rules of the manufacturing process. Okay, timing, layout, power, physical constraints, verification requirements, and then everything else that changes from one process to another, okay? So Synopsys, they work directly with companies like TSMC, Samsung, and Intel Foundry so that its tools support these manufacturing processes, okay? So the foundries, they validate and certify design flows that are built around Synopsys tools, which then gives the chip designers confidence that the design that they are creating, it can actually be manufactured, okay? So this makes Synopsys much harder to replace. A new competitor does not only need better software, it needs to build relationships with the foundries as well, and then support the newest manufacturing process. And then it also needs to prove that the tools, they work reliably, and then convince the semiconductor companies that design chips to trust these tools with extremely expensive chip designs. So that ecosystem has taken Synopsys decades to build. And in my opinion, you cannot replicate something like this. It's just not possible. Now we're going to talk about complexity, which is another part of the moat and another concept that I use in my investment framework. So complexity is going to be the tailwind for Synopsys. In a lot of industries, more complexity is a problem. Here for Synopsys, the more complexity actually creates more demand for the software. So as chips get more advanced, you have more transistors, then you have smaller processes nodes, chiplets, 3D packaging, chips being put on top of other chips, extremely complicated stuff, HBM, high bandwidth memory, more power constraints, more heat, and much more verification work. So every new generation becomes harder to design correctly. So that means semiconductor companies, they need better tools, more simulation, more verification, more automation. Synopsys benefits because its software becomes more and more important as the engineering problem becomes more difficult. So this is what I like to call complexity lock-in, okay? As complexity rises, and in the semiconductor industry, complexity has only one direction, up. Complexity rises, okay? So as complexity rises, Synopsys and Cadence and Siemens EDA, they get more and more locked in, okay? So complexity is not just something that Synopsys has to survive. This is actually strengthening the moat. The harder chips become to design, the harder it is for customer to use simpler tools, and the harder it is for a new competitor to appear or to catch up. The second part of Synopsys is design IP. So instead of every chip company designing every single component from scratch, they can license proving building blocks from Synopsys and then integrate these blocks into their own chips. These can be things like PCIe, USB, memory interfaces, security blocks, and on other connectivity technologies. So the value here is obvious. If Synopsys already has a tested piece of IP that works, the customer can save time, reduce engineering costs and work, and then lower the risk of designing that component incorrectly. So this is another form of kaboom prevention. A chip company does not necessarily want to reinvent a very complicated interface standard every single time it builds a new product. It can license something that has already been developed, validated, and then used across the industry. So design IP is a very different business from the core EDA software, but it fits philosophically, it still fits Synopsys very well. The company is basically selling trusted technologies that help customers move faster and avoid mistakes. The main difference is that this part of the business has been more volatile recently, so later in the video, we're going to take a look at whether that weakness is temporary or maybe something more structural. Synopsys has fairly recently acquired ANSYS, and we're going to talk about ANSYS a little bit here. So ANSYS expands Synopsys beyond just chip design, okay? Synopsys helps engineers design and verify the electronics, while ANSYS helps simulate what happens when the design has to work in the real physical world. So that means things like heat, structural stress, electromagnetics, power, fluids, mechanical behavior. And this matters more and more as chips become even more powerful and more complex, because the chip itself is only one part of the system. So strategically, the acquisition makes a lot of sense. Synopsys is trying to move from being a chip design software company toward becoming a broader engineering platform that can help customers design the entire system around the chip. So for me, that potentially strengthens the moat because more parts of the engineering workflow can sit inside the same ecosystem. So the big question is not whether ANSYS is a good business. Actually liked this ANSYS a lot before it was public. When it was public, I was invested with it. So the question is whether Synopsys paid too much for it. And we're going to look at the numbers later because the acquisition, I love that they did acquire ANSYS and that I have the opportunity to buy Synopsys right now at this price level. But we're going to take a look at the numbers to see if they overpaid. I don't think so, but the market certainly is punishing Synopsys for it. Okay, so here we are in stockanalysis.com. Highly recommend this website for analyzing stocks. You can get 10% off by using the code Unhyped or just use the link in the description. But yeah, as you can see, minus 35% in the last year for this stock. So last 12 months. And then over the past 5 years, this is down 23%. If we compare to something like Cadence, which is pretty much the sister of Synopsys, this is up 100%. So that's a massive difference. Okay, even the S&P is up over the same time period, 70%. So basically, whenever I see some kind of discrepancy like this between an extremely high quality company such as Synopsys, so 23% compared to 70% of the S&P 500, I immediately start to, and of course, compared to 100% of the sister Cadence design systems, I get very interested and very excited because this is a real opportunity. Forward PE of 25 for this company. So PE ratio of 93. You might look at this and think, oh, it's quite expensive, but it's really not because the margins have collapsed in this company after the acquisition. We're going to talk about it. We're going to talk about that. So basically, the market has been punishing this stock because of the ANSYS acquisition. And since then, the price has been going mostly sideways and violently. But if you take a look at here, so you have one violent rejection in 2025 at the level of 388. And then again, 388 got rejected. A lot of buyers, serious buyers, started to show up. 380 again. And then fourth time, 373. And now we're at 394. Like I said, I bought the stock recently. Also, like 2 weeks ago when it was under 380. I think this is a very good price point to entry. And we're going to take a look at all of the numbers here. So here, the revenue and profits shown in a graph here, very nicely going up over time. But let's just go to the income statement. So revenue growth, trailing 12 months, 40% and 50%, 15% last year. This is because of the acquisition. It's not going to have Synopsys on its own is not going to produce 40% of top line revenue growth. It's just not possible. It's not even possible. So this is not non-organic growth, but keep in mind the acquisition because a lot of numbers are going to be distorted here. But we want to take a look at next net income over time. So basically, we want to take a look at anything prior to 2025 because then it's going to get the numbers of ANSYS is going to get incorporated in here as well, and the numbers that resulted from the acquisition, so debt load and stuff like that. So actually, if we change the data source for the NASDAQ, because this is a very old company, like 40 decades or something like that. So as you can see, growing nicely since the 2000s, very consistently. This is not like super cyclical either, like the rest of the semiconductor industry. Of course, it does have cyclicality, but honestly more in price than in the financial numbers. So shares outstanding, this is going to be very distorted because of acquisitions over the years. And yeah, but it has some periods where it just buys back quite a bit of shares. Stock-based compensation is present, but with a company like this, I'm very happy to own it without without it being a share buyback monster. So not looking for crazy buybacks here out of EDA software, okay? Free cash flow, more and more and more. Obviously, this is going to be a bit more rocky, but yeah, more than $1 billion in free cash flow since 2021, 1.4 actually. And then operating margin, for many years, it was sitting in the high teens, also passing 25, 23%. This was nice. So this is this annual? Yeah, this is annual. Let's take a look by quarterly as well. See how that looks. So yeah, a little bit of cyclicality, but yeah, very nice gross margin. And as you can see, since like 2014 and beyond, they got better and better. They got higher into the 20s and dropped since then a lot because of the acquisition. So we're down to like 7%. Actually, the S&P Global gives us some other numbers, other formula to calculate, but yeah, I like to use mainly S&P Global. So we're sitting at around 10%, going down from 25 from prior of the acquisition. So if everything normalizes, I would expect to see 20% or more in margins in the upcoming years, 2 or 3 years. ANSYS also had quite nice margins. Let's see. Hey, and ANSYS. Even though it was delisted, we can still look at the numbers. This is why I love stockanalysis.com. I can look at some other company that was acquired. Okay. So yeah, the growth was mid-teens, 15% before it was acquired in 2025. Was hovering around 8% at the lowest point. But yeah, let's take a look at the margins. Gross margins for this company, 92%. Nice. I actually forgot. I thought ANSYS was a bit weaker in margins than Synopsys, but as you can see here, extremely highly profitable company. 20% operating margins. I am very glad to see, and I'm very glad to have gone to this page of ANSYS stock. So yeah, we're analyzing ANSYS, now part of Synopsys. Around 30% free cash flow margins with, like, let's say more than 10% average top line revenue growth. I mean, this is the rule of 40 is more than 40 for this company. What else can we take a look at? It had cash, but long-term debt, basically nothing. Yeah. Net income, very nicely. But they also had quite a bit of stock-based comp. Half of the net income, 300 million. But for net Synopsys, it's not that bad, actually, if they incorporate all of that stock-based comp. They were doing some repurchases, but the ratios, let's take a look at the P. So they bought this at a forward P of 31, non-GAAP. So actual P was like 29 probably, if we take the GAAP numbers, so not the adjusted numbers. So 30P, they paid quite high, but we have seen the margins and the quality of ANSYS was excellent. Gross margins, everything was excellent. And you have to keep in mind that they didn't just buy a feature that they added to the portfolio of tools, okay? This is basically them expanding into new territories, expanding their TAM, total addressable market. They're going into new industries beyond the semiconductor industries. And 30P, 40P, in my opinion, is a very nice price to pay for something like ANSYS when it makes a lot of sense and it will reinforce the moat. It will make the moat of Synopsys even deeper over time. So I think it's great that I actually had the opportunity to buy this 2.7 free cash flow yield. So it's more, I'm a lot more interested about the moat that it paid. So very simple-minded investors, they look just at the numbers and they see, oh, they took on a lot of debt, yada yada, they paid a lot, better stay away from Synopsys. But I care a lot more about the philosophy. What does this mean for Synopsys in terms of moat, in terms of competition, in terms of the growth engine? Are they going to grow into new industries? what's the future for this company? Most people, they just look at an acquisition and they try to see the short-term economics of that deal, which is stupid. I mean, of course, investing is for the long term, not for the next 12 months. But yeah, let's take a look at the balance sheet for Synopsys. So cash and cash equivalents, 2024, they had about 4 billion. So they kind of prepared for this acquisition. They kept more cash into the bank and they still have 2.4 billion. So they can use this right now for more buybacks, which is nice because the price is quite depressed. And you're going to see that Synopsys management actually does care about buying back more stock when the price is depressed. So long-term debt is 10 billion. They had, prior to 2025, they had nothing, 15 million. It doesn't even show on the graph. So I love this company because they do need quite a lot of money for R&D, but not so much that it goes into debt. I don't have any problems against companies using debt, but this had none prior. It didn't need debt. So went up to like 13.5 billion after the acquisition. And it already went down in the trailing 12 months down to 10 billion. So this, by the end of the year, it might even go down some more. But as you can see, they have already been paying down some of the debt, which is perfect. I mean, what more can you ask? So shareholders' equity here gone up massively since the acquisition. That's to be expected. Total debt, 10 billion. Net cash, only minus 8 billion. So they were net cash positive about 3.3 billion. Negative 11, and now trailing 12 months, negative 8 billion, which is around a little bit more than 10% of the market cap, which is very acceptable. So the acquisition was extremely important from a strategic point, but it's not devastating. It's not like AMD when they bought Xilinx for like 60 billion, and that acquisition was a lot crazier, and it did not close so many loops for AMD that when you compare that acquisition to this one. So yeah, this is much more moat reinforcing for Synopsys. Net income 2024, 2.2 billion. Perfect year to just go on an acquisition spree and acquire the most important company that you could have ever acquired. ANSYS. Perfect. I mean, it just went beautiful for them. It's just that the stock price has been punished. That's it. But I also love that aspect as well because it gives us an opportunity to jump on buying Synopsys right now. So 2021, they accelerated buybacks because the stock started to fall. They bought back even more, 1.3 billion in 2022 and 1.4 billion in 2023. Perfect. The accelerated buybacks when the stock price went down in the toilet. It did not go down by a lot, but it does show that management, they're going to be like, hey, we're not stupid here. We're going to cover the dilution that stock-based compensation creates. So we're not going to dilute the shareholders. And when the stock price goes down by 30, 35% or more, we're going to accelerate buybacks, okay? So 2024, 2025, they prepared for the acquisition. They kept a lot more money in the bank. But now they did 600 million trailing 12 months compared to last year, 300 million. So they already did more than double than they did in 2025. And yeah, sure, 600 million is a lot less than 1.4, but they've been also paying down debt. So they've been deleveraging. Beautiful. I mean, this is flawless. I love this. Free cash flow, obviously, it's going to go up by a lot. But yeah, it was looking nicely even before. So yeah, stock-based comp after the acquisition. So as you can see, 700 million bumped up to like 900 million and then now 1 billion. It's not a lot for something like Synopsys that deals in extremely complex stuff. This is a very complex industry that they solve problems in. So they need talent. They need to pay the engineers, the software engineers, and they do attract talent by giving out stock-based comp, but it's not at the expense of the shareholders because they do sensible buybacks. And the stock, the market cap is 75 billion right now, but 1 billion compared to 75 or 80 billion. It's just not that much. And if this grows sensibly over time, while the net income will continue to grow higher and higher, it's gonna be a much better deal for us in the long term. It's just the cost that you have to take, the stock-based comp. So that was pretty much it. I mean, what else can we look at here? Not much. You know, like I said, the price, 1, 2, 3, 4 times support at this price level since 2025. Pretty much, yeah. That's the only thing I wanted to show you guys about Synopsys stock. So good luck to you if you buy this before August 26th. I bought it, but not. I think it's a great opportunity when the stock goes down before the earnings date, because a lot of negativity is already priced in, and the risk is not to the downside so much anymore, because it's so, I mean, look at it, it's very close to the support line. So if it does go down, it goes down from the price of 395 down to like 380, 375, something like that. It's not going to plummet by 40%. But anyway, I'm not buying this as a trade. I'm buying this as a long-term hold, because the discrepancy between 23% over the last 5 years compared to something like Cadence, which is 100% over the last 5 years, it's just extremely high. And yeah, this is what I'm looking to exploit, and this is how I'm looking to outperform the S&P 500.